And Medicare is the same thing. Instead of just paying for it based on age, pay for it for the people who actually need it. If they already have money, if they already have a nest egg, they have to pay for their own healthcare first. And what that'll do is it'll actually drive healthcare costs down.
Hello and welcome to Capital Cosmo, everybody. Today we have a very special guest, Joseph Brown from HairSafe Financial. Thank you for coming on the show, my friend.
Yeah, thank you for having me.
So before we get started, nothing in this video is financial advice. Neither Joseph nor I are financial advisors. Please do your own due diligence. It's your money, your responsibility. With that said, Joseph, tell us a little bit about yourself. Can I call you Joe?
Yeah, call me Joe.
Yep.
When I got married, my wife and I were in a pretty bad financial situation. We had about $30,000 of debt, and my wife was making about $35,000 a year, and I was making less than minimum wage. And so we had quite a bit of a hole that we had to try and get our way out of. I started reading books about personal finance, money management, and kind of just that sparked my curiosity, and I started thinking, man, I really like this stuff. So I had a friend who was a financial advisor. Started talking to him, and he was like, hey, look, if you really enjoy this stuff, you've been talking about, you've been learning it, why not try and pursue a career in this? And he said, I can get you in the door, get you in as in the broker training program. So he helped me get hired as a stockbroker, and I fell in love. It was like, basically I tried to do everything that I could, all the different jobs, move from one to another within the industry so I could try out, it was all about, learning how the system works, learning how money works, learning, how the economic machine moves forward. And at a certain point, I started realizing, hey, I'm coming up against things that, I'm hitting walls. So I get to a certain point and start to, try and dig in and, why does this happen? What is the relationship between interest rates and inflation, and what impact does the Federal Reserve's monetary policy have on the economy? And I started to realize that, number one, none of the experts knew what they were talking about. You start to be able to say, okay, well, that's just bullshit. Like you don't know what you're talking about there. That's just, you're saying words that are meaningless, trying to act like you know what you're talking about. And when you pull it back and you realize, oh my gosh, they have no idea. That was number one. And then number two, it was like, when they thought they knew, it was like, well, that doesn't actually make sense. Like a common example is like, attributing bull markets to animal spirits, which is just another way of saying, for some reason, people become irrationally bullish and start buying. It's like, okay, well, that doesn't explain anything. So I started to do some research on my own. Basically, I started reading books, trying to find, podcasts and YouTube videos and books and like anything I could to try and figure out, okay, if I can't get any further from inside the belly of the beast, I gotta, see if there's any way to understand how this whole thing works from another source. Got introduced to Austrian economics. I discovered, Peter Schiff and that sort of Ray Dalio, and suddenly light bulbs actually started coming on for the first time. And I was like, okay, now, this makes sense. Broader explanatory power over, the way these things work. And it got to a point where, number one, I had always wanted to work for myself, but number two, it got to a point where I'm like, okay, what I'm selling, I don't actually think is the best thing for people long term. And so that's when I quit my job and started Heresy Financial, so I could start to teach people how money works, so they could make educated decisions for themselves about the best way to grow and protect their wealth.
Nice. So you spoke about the importance of starting your own business and just kind of branching away from a 9-to-5, away from being an employee to something along the lines of an entrepreneur. Why is that? First of all, do you think that is more important today than at any other point in history? And why is that?
I would probably say that maybe not more important than any time in history, but it's definitely up there.
Yeah.
there's been a massive consolidation in jobs, especially in the United States, over the last, let's say, century. There used to be a much wider distribution of where the jobs were. Much smaller businesses and many more businesses compared to the number of employees. And the more consolidation you have, the more risk you have in the system. The more centralized things are, and the more you have risk of collapse. And so there's a very big false sense of security in the average everyday job. And so I would say, like, the baby step would be seeking that decentralization yourself. And you're gonna have a lot more. If you're seeking security or safety, there's going to be a lot more or a lot less fake security if you're a part of a very small team, a very small business. Large corporations, there's just a very large sense of security that's not actually there. They don't care about you. The potential for growth and the skills that you'll learn don't translate as well to real life. I mean, we're seeing this right now, where everybody thought tech jobs are the best jobs in the world, and right now there's more layoffs than there were since the dot-com bubble burst. So that'd be like the baby step number one. But number two, when you like, first, a lot of people say not everybody can run their own business. And it's like, okay, there's 8 billion people on earth. And every person, has to eat, has to consume, consumes entertainment, some amount of leisure, has to travel, has to, have basic necessities. It's like you're a consumer in 99% of your life, and you're a producer in 1% of your life. So theoretically, it is possible for everybody to run their own business. But I'm not talking to everybody. I'm saying anybody can. There's a difference between saying anybody can and everybody can. And everybody won't. So anybody can. And what it does is it forces you to acquire skills that actually make you really robust and really secure. Because if you can build something that somebody wants, and you can learn how to get it in front of people and persuade somebody that they want to buy it from you, now you have no doubt you've eliminated your own downside for the rest of your life. If you have those skills, if you can build, and if you can sell. And so you might feel less secure because it's all on your shoulders, but having that responsibility on somebody else's shoulders, especially a large corporation that doesn't care about you, is just a false sense of security. And so I think it's very important, if not more important than ever, for people to, at the very least, try starting a side hustle, make a small side business, make it profitable, and then see if you can grow it to the point where you can replace your job with it. You'll eliminate your downside risk, and then your upside potential is almost infinite. You're not capped by your manager not liking you, or somebody else, getting a promotion over you. It's just, how far do you want to go?
Yeah. Yeah. When you're trying to be someone else at a 9-to-5 employee job, you're kind of capped by the role itself. But when you're out on your own, working on your own, you're being yourself, and there's no limit to what you can be, in terms of being yourself. So we talked about, starting your own business, but when it comes to earning money and earning capital, how do you allocate your capital? Is the dollar, is fiat considered money? Is that capital? What's your definition of money?
Yeah, so I guess if you approach this from a portfolio allocation standpoint, it is necessary to have three main categories. The first category would be reserves. And so this is not an investment. This is not a speculation. This is reserves. This is there so that when asset prices go on sale, you have dry powder to be able to buy them, right? And then when risk is realized in your life, when the hard times come, you have a safety net that you've built for yourself. So reserves are absolutely important. And this is, most people, when they think of reserves, if they're traditional investors, they think bonds. If they're the average person, they think cash, like fiat, like dollar bills. And right now, I think it's good. Like, more people are realizing, when you save dollars, you're putting them in a bank. So there's the risk that the bank goes under. But then you have to ask, okay, what is the bank doing with those dollars? Because those dollars aren't staying there. And that bank is loaning those dollars out to somebody else. So not only do you have the bank's risk on you, you also have the risk of whoever the bank loaned that money to. That could be the United States government, could be somebody else, could be a mortgage, could be, whatever. And so there are multiple levels of risk when you save with dollars in a bank. And so the point of reserves is so that you have dry powder to be able to buy things when you need them. And normally, when those situations come up, it's like there's blood in the streets. Everybody's panicking. Times are really tough. There's crazy things that nobody expected, which is those are the kind of times when banks are in trouble, when there are, limits on withdrawals and things like that. So I'm not saying that nobody should have any money in the bank, because part of it is being able to pay your bills, and your bills are denominated in dollars, especially if you have debt. And so you do need some cash. But I don't keep the majority of my reserves in US dollars. Certainly some, but the majority of it is in physical gold. The majority of my reserves is in gold. Purchasing power has stayed the same for thousands of years. It's a little bit volatile, but over a long period of time, it's really not. Some of it is in Bitcoin, because that's an optionality that's, your purchasing power might increase. And then some of it is in cash. And so having a mix for your reserves, I think, is really important. And then for part of your portfolio, you got to be in business, in equity. You've got to have an ownership stake in businesses. That could be your own business that you're building. That could be large public corporations like the S&P 500, or it could be like private equity. You can invest in startups. You can buy small businesses, like mom and pop businesses from people who want to retire. Even like using SBA loans and things like that. So having ownership in a business is what gives you the big upside for creating wealth, that big compounding interest component. And then the third portion that is really important is cash flow. It's not, there's really no such thing as passive income, but as close to it as possible. So like real estate, where you have an income producing part of your portfolio. And that's never going to be the piece that exponentially increases and makes you super wealthy, but it's going to be there to provide you income. It's going to be able to be there to fund the other two portions of your portfolio. It's going to give you some stability in your portfolio, and it's still going to have decent growth over time.
Awesome. Well, you mentioned gold there. We in the US, we depegged from a gold standard back in the 1970s. But ever since then, you started to see wage growth kind of decouple from the inflation rate because of that. And it kind of goes to your point why, working for yourself as opposed to being an employee is so important. Because, you don't want to be tied down to that employee wage growth as well, that's being hampered down by a depreciating currency like the US dollar is. Historically, we might be seeing upswings in the dollar momentarily as capital flies to the US, in short-term assets and stuff like that. But historically, on a long-term basis, the US dollar has lost a good bit of its purchasing power. And what are some of the downstream effects of, would you say, us as a society moving away from sound money and into what we have today? We've been talking about raising the debt ceiling, and we're at $32 trillion in debt. What do you see as some of the downstream effects of that, societally speaking?
Yeah. This is compounding interest works both ways. And so there are certain things in life where intensity, short bursts of intensity is meaningless. It's the direction and the consistency that matters. So like working out, this is a good example of this. It is not possible to work out intense enough in a 24-hour period to transform your body. So the level of intensity is meaningless if you're only going to do it once. The only thing that matters with exercise is consistency and direction. And so I'm going to work out for 30 minutes every single day. 3 years later, my body is completely transformed. I have muscle mass, I have a lot less fat, my energy levels, health levels, all of that, right? And so that's the compounding interest. It works both ways. And so one day, if I decide to eat, Doritos and Oreos and drink soda, eat ice cream, and I don't sleep and everything like that, that's not going to do anything. Nobody will be able to tell. They'll look at me and think you look the same today as you did yesterday, as you did 2 weeks ago. And that one day of intensity of going the wrong direction will have zero impact. But if I do that every day, then 3 years from now, I will be fat, miserable. I'll feel sick. And, I might have to be on, some blood pressure medication or whatever. Right. So it's the consistency and the direction that matter. The situation that the United States is in right now, financially speaking, is the exact same thing. If we run a $5 trillion surplus next year, which is impossible, but we run the biggest surplus we possibly could, it would be meaningless compared to the direction and the consistency, the direction that we've been going. Versus like if we were to say, okay, we're going to just say, legally speaking, we've got to reduce the total spending by 5% every single year. And don't do anything else. Just, okay, we spent 6 trillion last year. This year we got to spend 5% less. The next year we got to spend 5% less. You'll never approach zero because it's a percentage. And so that would be akin to working out every day. It's not going to fix it today. It's not going to fix it in a year, but 5 years and 10 years will be in a lot better position. And the fiat monetary system decoupling from gold, it has allowed us to pursue that unhealthy direction consistently for a long time. Where our country is, fat, sick, miserable, on medication, on, life support, and nearly dead. Because it has allowed it has allowed that extra spending, ignoring the future, borrowing, mortgaging, the financial health of our future today, for a much longer period of time than we could have if spending was anchored to something like gold. And so that's the position that we're in right now. This is not unique. Like, this same thing has happened in dozens of countries throughout all sorts of different political regimes, different political styles, different cultures, all throughout history during different times of technology and across different continents. And the result is always the same. It eventually just results in a complete collapse. Like, Rome is a city today. It's not a global empire. Greece is a small broke country today. It's not a global empire. China is the one where it's like, okay, they've actually come back. They used to be a leading empire, had many centuries of not being that after they collapsed. On their way back right now, looks like they're not actually going to make it to the top, and they may have peaked. And so what the United States is going through right now, we have small little focus on. We think, the United States is on top of the world. Who could ever displace us? And it's like, well, we could displace ourselves, and we're doing so consistently every single year. And if we don't turning around is all that matters. Doesn't matter the intensity. Let's just turn around. We got to go the right direction. But so far, we're not.
Perfect. So I briefly mentioned the debt ceiling talk. So I've got to bring it up. What do you? So it looks like we have a deal seemingly on the table. What should, not what will, but in an ideal world, what should we do with the debt ceiling dilemma?
Mm-hmm.
Your opinion?
Yeah. So there's a couple different ways to look at this. And so I will give you just my opinion about what we should do that would result in the best outcome for as many people as possible, basically. We right now we are spending money that we don't have. So it's not like there's this situation right now where they're saying, hey, we've got all this income, and you're arguing about, where we should spend it most wisely, and everybody's being selfish and they want to spend on themselves. It's like, no, they're arguing about money that's not there. This money's not there. And so we're actively running faster and faster towards our national collapse. by doing this. And so when I'm about to talk about like severely reducing our spending, it's not about being selfish or saying, hey, rich people should, keep more of what they have and poor people should. It's like, no, this is just stopping the bleeding. Like that's it.
Right.
And so for numbers, the federal government pulled in like $4.1 trillion in taxes in 2022. No, I'm sorry, it was 4.6 trillion. And it'll likely be a little bit less for 2023, obviously, because of the difference in prices and inflation, all that. So let's just call it 4 trillion. 4.1 trillion is the amount that the government spends on mandatory expenses, and then 1.7 trillion is the amount they spend on discretionary spending. And when you break it down by category, there are some very easy things that you can cut to get to a balanced budget, meaning we're no longer borrowing, you're just spending everything they take from taxes. And the amount they've taken from taxes goes up every single year, and they just spend way more. And so it's very easy, dollar wise, if we return to a balanced budget, meaning we're no longer borrowing, we're just spending what we pull in from taxes. That means we're spending the same amount of money that the government spent in 2017, 2016, 2015, and then it's a surplus from there all the way back throughout human history. So all the Bush years, all the Obama years, everybody's like, the government's spending too much. But as long as we return to that, where it was too much back then, we'll be running surpluses. All you have to do is cut out student debt, student loan financing, all the money the government is sending to universities, which is like, the experiment has been done. All they've been doing is driving up university costs, because every time students get more free money from the government, then universities just raise their price. The quality of education doesn't increase. They hire more administrators, and the return on investment goes down because now more people have degrees, and so that degree is actually worth less in the marketplace. So you're loading up these kids with student debt that they can't get rid of through bankruptcy. They have no job yet. They have no income. They have no assets, and so working, and they should actually be making money. And then 4 years later, they'll have a positive net worth instead of being in debt 100 grand.
Hey, Joe. Hey, sorry. I
Yeah.
think my internet cut out for like 10 seconds there.
What was the last thing I said? I'll go back.
I think you said like if we just rein in spending to what it was only a few years ago.
Okay. All right.
So
So
we'll
if
making note of my
just
editor, cut this here.
give me a flag if it happens again.
Yep, we'll do.
So if we rein back spending to just what it was 2017 and prior, then we're running a surplus. So it's still spending too much, but it's at a step in the right direction. One of the easiest places to cut is student loans. When we're financing that, number one, we're loading up kids with debt that they'll never be able to pay off. They can't get out of it through bankruptcy either. Number two, we're subsidizing universities, meaning they raise their costs. Every time students get more money from the government, university costs go up. And so it's not making college a better investment. It's actually making a worse investment because now you're loaded up with debt, so it costs more. And now more people have degrees, which means that it means even less than it used
to. You've diluted the value of the degree.
Exactly. Yep. There's that dilution. And you're loading up people with debt. These are students, and so they have no assets. They have no job, they have no income, and so they're the worst people to be able to load up with a ton of debt, and so they have no proof that they'll ever be able to pay that off because they've never had any history in the job market. And the kids who go and get a job right away, 4 years later, they've made money, they've earned skills, they've moved up the corporate ladder, they've started to get ahead, and meanwhile the student gets a degree in general studies that no employer cares about. They're going to have to start off at the same place as the 18-year-old did when they get a job, but they have $100,000 worth of debt. And so it's the stupidest thing for the government to be funding, because all you're doing is enriching universities with these large funds, and it's hurting everybody else. So that's the first thing to go. there's a lot of other discretionary spending that I've detailed that you can go through. One of the biggest things that like this is like the most hated. People hate it when I say this, like left or right, anything. This is one of the most controversial things I've ever said. But Social Security and Medicare should be means tested. So what that means is like right now, we're sending money to seniors and we're saying, hey, you paid into the Social Security fund, so we're just giving the money back to you that you paid in. That's a lie. They were lied to their whole life. I'm sorry, it sucks. But when they paid into it, they were paying for the people who were living off of it. It's just a Ponzi scheme. There's no money left over from what they paid into it. That money's gone. I mean, it'll be gone in 2033. But so that was a lie. So we can't just keep on lying to people. The money's not there. What they paid into it is gone. Number two, I'm not saying that these seniors should be plunged into poverty. If they need it, we can still afford to give it to the people who need it. But we have Social Security checks going to people who don't need it. They already have income from their retirement plans, from their pensions, from the money they've saved up, from their rental properties, whatever. And they're also receiving Social Security. All you're doing there is subsidizing inheritances. So you're minimizing the amount they have to draw down from their regular retirement, from their, their 401k or their IRA or whatever that is. And so when they die, they have a larger amount that they can pass on to their heirs because taxpayers are subsidizing what they have saved up their whole life for. And that's not right in any sense of the word. Taxpayers should not be, and because taxpayers are the youngest and the most productive people in the workforce. People who are retired are by definition no longer productive. And so if they don't need it and they're no longer productive, why are we taking money from the most productive people in society and transferring it to the least productive people in society? At least make them use up what they have first, and then it should be means-based. And Medicare is the same thing. Instead of just paying for it based on age, pay for it for the people who actually need it. If they already have money, if they already have a nest egg, they have to pay for their own healthcare first. And what that'll do is it'll actually drive healthcare costs down. Just like education, if you get rid of all the money that the government is just throwing at healthcare, competition enters again, companies go out of business that are surviving on all this free government money, healthcare costs go down, and guess what? Everybody benefits then. And so I'm not saying that anybody who needs it shouldn't get it. I'm saying that it should be based on who actually needs it instead of just throwing money just because you're old. Because the fact of the matter is the money's not there. So it's not like you put in this money to a savings account, you're just getting back what's yours. That was a lie. It's gone, and we shouldn't pretend that it's still there. If we make Social Security and Medicare needs-based, we bring the troops home, and we cut out all the other, unnecessary spending like student loans, we'll have easily $1 trillion surplus that we could either keep and start reducing the debt, or just reduce the reduce taxes, and the burden that the government is on the economy will be so lifted that the productivity in our nation will skyrocket.
Yeah, and I think Ron Paul also had a similar plan back in 2012 or 2011 when he was still in Congress. He made a simple proposition: let's just cut back spending to what it was 2 years ago, like a simple already elevated as it was 2 years ago, and it was still no bueno, with Congress and the rest of the bureaucrats there. So what would happen though if the U.S. doesn't raise the debt ceiling? Does the U.S. default if that happens?
Good question. Everybody says that will happen, and in reality, that's not what will happen. So if the government doesn't raise the debt ceiling, they already have borrowed the maximum amount that they're allowed to borrow. And so this is like you've got $100,000 limit on your credit card, you've spent $100,000. If you want to spend more money on your credit card, first you have to pay that credit card down, then you can pay it back up again. So the government can do a balance transfer, and if they've got $1,000 due that they have to pay back, they can borrow $1,000 new to pay off the $1,000 that's due. Now, the difference there, because then that doesn't change the amount of debt that they have. The difference is obviously the interest rate, because they still have to pay the interest. So where does that money come from? Well, during 2023, the total amount of interest that they have to pay on their debt is going to be somewhere around $650 billion. We already said that the government brings in $4.5 trillion in taxes. So there's plenty of money coming in from taxes to pay the interest on the debt. So the debt's not an issue. borrow more to pay off the principal. You get your taxes to pay off the interest. So the money's there, plenty of money for that. So it's not a matter of, hey, we'll default on our debt. In fact, the Constitution and federal law both mandate that the government pays their debt. So if push comes to shove and they say, hey, we've got all these bills and the debt gets paid first per the Constitution and federal law. The only way a default actually happens on the debt is if the president decides, no, don't pay the debt, pay everything else. And that would be in violation of federal law and the Constitution. And he probably wouldn't do that, considering that would be the end of America and the end of the global financial system. So the debt would get paid. Now, there's not enough money then left over to pay everything else that they planned on paying. So they cut out, all the discretionary stuff first. Social Security would get paid out of the Social Security fund. And so that would still get paid. But they would definitely have to stop paying on a lot of other things, especially things that they currently consider mandatory, because they have written laws that say, hey, these expenses are mandatory. But just as those laws are written, those laws can be undone. The government would be shut down for a period of time. So it would be painful for some. But ultimately, the debt would still get paid. The debt would not be defaulted on. And in my opinion, the best situation possible.
Got it. Well, we've been running up this debt, and as a result, we've also been seeing, inflation. We say that we've only been seeing disinflation over the last 20 or so years, and it's become inflation over the last couple of years. Now, again, like if you look at the value of the dollar over time, especially since the decoupling from the gold standard, the dollar's value has gone down like 95, like over 90%. I don't know the exact number off the top of my head. But the point is, with inflation currently sitting at, what is it, 4.8%? We've come down from 9.5 or 9% or something like that. Are we going to? Do you think we are going to continue seeing inflation coming down? Do you think this is over? Do you think we're heading more into a deflationary doom cycle, as they would put it, or maybe something in between, like stagflation?
Yeah, this is one of the things that I've recently had to change my mind about in light of evidence contradicting my forecasts, because I thought that by the end of Q1 this year, inflation would be under 2%. The official inflation rate would be under 2%. And the reason for that is because of the money supply. And we had a big money supply, all else being equal, the money supply will have the most influence on what prices do. If you if you increase the amount of money in the system, that money will work its way throughout the system and bid up prices. Similarly, if you decrease the amount of money in the system and you pull money out, then there is not enough money in circulation to keep prices at those high levels. Prices must adjust downwards to the new aggregate level of money in the system. And it takes a while for these effects to hit the economy. So they printed all that money in March of 2020. It wasn't until March of 2021 when the official inflation rate was back up, because it went negative. It was back up to the average from the last 10 years, back up to 2.5%. Skyrocketed from there. And then in January of 2021 was when they stopped printing money. And then in April of 2021 is when the money supply finally peaked. So since April 2021, the money supply has been decreasing. So there's a lot less money today in the system than there was in April of 2021. It's lower than it was since I think September of 2021. So we have 1 year to a year and a half right now of decreasing money supply. So my anticipation was that would have pulled prices down. What I did not anticipate was two factors that increase inflation. I did not anticipate these factors being enough to offset the decrease in the money supply. The first one is velocity. So money velocity has been falling off of a cliff, but over the last year or so, money velocity has actually been increasing. So velocity is not necessary to get inflation, as we've seen. Velocity was tanking, money supply increasing, we got the inflation. So you don't need velocity to have inflation, but velocity is sufficient. So if velocity does come into play, that can cause inflation despite everything else that's happening. And so like if I in 1 year I spend $1 and I give it to you for something, then that velocity, $1 went from me to you during that year. But during the same year, if I buy something from you with $1, then you buy something from me with that dollar, and then I buy something from you with that dollar again, well, my income doubled, even though it was the same dollar. And so even though the money supply didn't change, my income doubled and my spending doubled. So velocity increasing can push prices up. And that's what's been happening recently is velocity has been increasing. And it's been increasing with a total money supply base that is more than it was back in like 2019 before the money printing. And so there's a greater effect from that. So we have money velocity increasing. The second piece is the deficits. And deficits cause inflation not because they increase the money supply, because it's borrowing from Jack and paying to Sally. So it's the same amount of money in circulation. But these massive deficits that we're running is, like I said earlier, taking money away from the most productive areas, because that's where the taxes hit, is wherever there's productivity, transferring it to the least productive. That's what, healthcare spending is. That's what Social Security spending is. That's what military spending is. That's by definition not productive because it's for destruction. Munitions and tanks and bombs and all that. And so we have this massive transfer to non-productive areas of the economy that causes a misallocation of resources and, all else being equal, a destruction of wealth. And so the money supply is decreasing. So that is a deflationary force, but we also have these other two inflationary forces. So we're getting a decrease in total wealth at the same price at the same time as an increase in prices. And so it's a very real, stagflation environment that we're facing right now.
Yeah, and I mean, to your point there as well, money velocity doesn't even have to increase. You could have money velocity stay constant with a depreciating money supply, and that in and of itself would also increase inflation too. So, because I mean,
that's
money
what we
velocity,
had in 2020 and 2021. We did not have velocity, but the increase of the total money supply made inflation happen.
Yeah, because money. I mean, to the viewers, I mean, I know you know this, but to the viewers, money velocity is simply GDP divided by M2 money supply or money supply. So if the denominator gets smaller, the overall ratio or fraction gets bigger, even if you hold the numerator constant. Cool. So de-dollarization, is it in play? And how long of a process do you think it'll take to see de-dollarization if it ever happens?
There are two different types of de-dollarization that we have to differentiate between. There are dollars held as reserves, and there are dollars used as global payments. Dollars held as reserves have been severely on the decline for the last at least decade, probably more. Recently, they've been replaced with gold, and that trend is actually accelerating. Central banks around the world are buying more gold than they've bought since right before the U.S. left the gold standard. So the global gold market is sniffing out another technical sovereign default and hedging that by purchasing gold, which is an asset that is not somebody else's liability. So in terms of reserves, dollars are certainly, there's global de-dollarization happening. In terms of using dollars as payments for international trade, there actually is no de-dollarization happening yet, which is kind of surprising, but you can measure it any way you want when you adjust for inflation, when you control for the size of the American economy versus the size of the global economy. The dollars are being used the same, a little bit more so than they always have been. They make up the vast majority of international trade. Part of the reason for that is just because that's the way it is. And so I might not want to use dollars, but the person that I'm buying something from wants dollars. So I have to get dollars to be able to buy the stuff that I want. And the only way to get dollars is to sell something that they want denominated in dollars. The second reason is because of global debt. So if Zimbabwe wants to borrow money from me, I'm not going to lend them debt denominated in Zimbabwe dollars, because then they could just print another $1 trillion Zimbabwe bill and hand that to me. So I have no guarantee of purchasing power there. So if I'm going to lend Zimbabwe money, I'm going to lend them money in a currency that they can't control, but one that they can get through global commerce. So I'm not going to lend them money in, an obscure South American currency, because they'd have a really hard time getting that if they don't have, trade with that country. So I'll lend them money in US dollars, because I have a high chance of getting that purchasing power back without them being able to intentionally control how much purchasing power they're giving back to me. And so because of this, there's a lot of global debt denominated in dollars. There's $65 trillion of global debt. And that is in comparison to $100 trillion estimated global GDP. So the amount of debt denominated in dollars worldwide is just staggering. And so countries are forced to get dollars when they do international trade, so they can make their debt payments, because those debt payments require dollars. So even if they don't want to use dollars for international trade, most countries are forced to, because of the debt and because of where they need to buy their stuff from. Now, that can certainly change, but there's no trend that is changing yet at this point. And in fact, the countries that are establishing bilateral trade agreements denominated in new currencies, like there's a lot of news about Argentina and China denominating certain transactions between them in yuan. When you dig deeper and you look at the reason why they're doing that, it's because they have such a shortage or such a problem getting dollars that they don't want to spend their dollars to China. So they're doing that so that they can free up their dollars for the other stuff that they need dollars for. So it's out of a need for dollars, not out of a desire to, not use dollars. And so ultimately, this will change at some point, but it's not a 6-month thing. It's not a 2-year thing. This is probably more like a 10 or a 20-year thing. And the global reserves thing is much different. When you're talking about purchasing power, when you're talking about reserves, it's like, yeah, I'm going to save in gold, just like the countries do, the central banks do, the sovereign wealth funds do. But people are still spending in dollars.
Yeah. And I think if you look at the total amount of debt denominated in dollars, it's like 97 or 98% of the world's debt is denominated in dollars. It's some huge amount, over 95%. Let's put it that way. Like Chinese yuan denominated debt is like 500, it's like equivalent to $500 billion. So it's still got a long ways to go before we see a complete de-dollarization, which is, kind of akin to what we saw with the pound sterling, right? That took, like you said, to your point, 10 to 20 years to transfer global reserve status from, one currency to another. Great. What markets do or sectors are you seeing, are you kind of long in? What do you see the most value in? What's cheap in your mind at the moment, if there is anything cheap?
Yeah. There's the things that right now I would stay away from are the things that are showing bubble dynamics. And it's kind of surprising that we're seeing another little bubble form, because it's riding the wave of the leftover free money, but AI is displaying a lot of bubble dynamics, a lot of the same indicators that the NFTs and crypto and work from home. And there were these waves since 2020 started of, hey, going from one bubble to the next, and AI is displaying that right now. I think it may very last one of these bubbles to form and then pop, riding that 2020 wave of money printing. And the reason why I say it's a bubble is not because that it's not going to be revolutionary or change things or money making to whoever lasts, but there's no moat, and there's no there's no moat. And so the competitive playing field for this drives everything to zero very fast. So you have the initial players that all get wiped out from competition, and somebody will win. There will be winners from it, but it's almost impossible to predict. And the other indicator of these bubbles is just looking at valuations. Like Nvidia's they've got like a 200 price to earnings ratio right now, which means that if they took all their profits and they paid all their profits, 100% of the profits in a dividend to their shareholders, it would take 200 years before you got back your investment in the stock. So those are unrealistic valuations. Now, areas that I see that are on sale right now, let me put it this way: there are more and more areas that are starting to become attractive. There are not that many that I see that are attractive yet, other than I would say like commodities are looking that way, and the stuff that people have to buy are the areas that when times get tough tend to do really well. So this is one of the reasons why like Berkshire Hathaway has done very well over the last, I don't know, year and a half, versus something like, Amazon or some of these tech companies are down 50 to 90% from their peak, versus companies, let's say like Berkshire Hathaway, they were not doing anything and now they're starting to perform well. Defaulting to the stuff that people have to buy no matter what is the play when times get tough, because people stop buying the luxuries, they'll stop buying the entertainment stuff, they'll stop buying the fun stuff, the tech stuff, the flashy stuff, the expensive stuff, and they'll be forced to put all their money, even at higher prices from the inflation, into the things that they must keep on buying. So, food, water, rent, transportation, gas, and then fixing things, because we live in a world of entropy, and so stuff breaks. And so the stuff that makes stuff, and the raw materials that go into that stuff, those are all things that tend to do better. And there's still, at this point, a lot of those areas are on sale.
Excellent. Well, thank you so much for coming on the show, Joe. Where can people find you?
Number one place is going to be YouTube, Heresy Financial. Number two place is going to be Twitter. My handle there is @Heresy Financial. And then I'm trying to get out on all the socials as well, not as active elsewhere. But you can find me on most of the other social media platforms as well.
Awesome. Any other closing comments before we head out?
Just I think the most important thing that anybody can do is, number one, de-risk. So, if you've got credit card debt, stat just came out today, the average person now has $10,000 in credit card debt, and the average credit card interest rate is like 24% now. And so that's going to kill your ability to survive. So get out of the dangerous debt, de-risk, and then start building a safety net. So start building up those reserves and study, get financially literate, learn how to, read financial statements, and see if a company is at a good price or not. And then you'll be able to take advantage of the deals as they start coming soon here.
Yeah. Best thing you can invest in, I will say, is just yourself, because they can't tax that. I mean, you can get taxed on capital gains. You can get taxed in every other facet in life. But when it comes to the knowledge and experience that you accrue as an individual, that stays with you forever. So very good. If you enjoyed this content, you guys, please hit the subscribe button for more guests like Joe to come on the show. If you also if you like this video, hit the like button, and I will see you in the next video. Bye, y'all.